Brian, this is with you. Your surprise for 2024 is that you think China will be the top performing stock market in the world next year. Can you take us through your rationale on this, please?
Of course, Linda, thank you. I think it's important to take a step back and really ground ourselves just for a moment in the Foord investment philosophy. And ultimately, when identifying securities to invest in or markets to invest in, it's that really the fundamental belief that earnings, and in particular cash earnings, do determine the true value of a company. So when we have that value, I mean, what is the determinant of a return then? It's really those earnings or cash earnings and the growth of those earnings over time, as well as changes in the multiple that the market may be willing to pay for those earnings. So certainly multiples can change based on the risk-free rate, as we know, based on equity risk premiums for certain markets, geopolitics, for example. But ultimately how you marry those two, if you get your entry point correct, so you aren't paying peak multiple for peak sentiment, but you're closer to a trough multiple than trough sentiment, then that's how you generate a strong return. And that's what we see in China as the setup for 2024. So the market's certainly trading at lows on an absolute basis, as well as lows relative to other markets around the world. And as you mentioned, for earnings that continue to grow. So if I look at really three reasons, and I'll just highlight two long-term reasons and one as we set up for 2024. So if we pull up the first slide, one of the reasons that we think China is attractive, and we've used this slide previously, is just the underlying growth in demographics. So the strong growth in the Asian middle class in general, and in large part, this is due to growth in the Chinese middle class. So as we look only from 2020 to 2030, we see that 54% of the world's population is hailing from Asia in 2020, and that moves all the way to 2/3 by 2030. What that means in absolute terms is 900 million new middle-class consumers will be created in Asia over that period, an increase of 25 to 30%. So that's really a big demographic tailwind. The second reason that we're constructive on China, and we'd like to show this slide, because we get questions around, isn't the population of China declining over time? But it's really important to take a step back and look at it in a bit more granular way. And here we're showing the urbanization rate in China relative to other Asian markets. So today, 65% of the population in China is located in urban areas. If we look at Taiwan and South Korea, for example, that's in the high 70s, low 80% range. And so you have another sort of 200 million people that are very likely to continue to urbanize in China. So while the overall population may be slowing in growth or declining over time, you have significant increases in productivity in the underlying workforce. And that really contributes to GDP growth. And then lastly, as I mentioned, it's really taking a look at the underlying earnings of the individual companies, the country, and the index itself. And what we see for the setup today, as we look forward, is 15% or so earnings growth at the index level. And this is 1.5 to 2 times what we see in other Western or developed markets around the world. But for that same or that doubling in earnings growth, one's paying only half of the multiple. And we can chat through some of the reasons why. But you're paying 10 times for earnings growth. That's double what you're finding in the rest of the market, where you're paying 20 times for half the level of earnings growth. And this is true whether or not we include growth from the Magnificent Seven or not. And I think that that's an important point to make.
Thanks, Brian. So all of that makes perfect sense. But a lot of the things that you've mentioned have been the case for quite some time. And yet we've seen Chinese stocks are significantly down this year. So first of all, I wanted to ask you, why do you think that's the case? And then secondly, of course, why do you think things will be different next year?
No, it's an excellent question. I mean, ultimately, valuation alone isn't the catalyst. Here we do have valuation coupled with very strong earnings growth. So that over time will be a catalyst in and of itself. But more importantly, I mean, looking, as you mentioned, at reasons that the market has lagged this year, there are really 3 primary reasons. One, the property market slowdown or overhang has weighed on consumer sentiment in the country. And we see that a quarter of GDP, 70% of Chinese retail wealth is concentrated within that property segment. So it's only natural as a Chinese consumer, if there's uncertainty there, to really kind of hold on to your wallet and not spend aggressively. But what we are seeing is some opening there. The down payment required on new home purchases, for example, has been lowered. We are seeing the party and state-owned banks come in and backstop projects that are under development. So we can go into more detail on that property piece, but really what we're seeing on the margin is an abatement of that overhang, and that will continue through 2024. And then the other reason is geopolitics. So we all follow, obviously, the chip wars and semiconductor restrictions coming out of the US, for example, that has restricted certain pieces of semiconductor equipment and technology to be exported into China, which certainly is crimping that leading edge semiconductor supply chain within the Chinese economy. And that certainly has been an overhang and will continue to be an overhang on that leading edge side for a period of time going forward. But what I think the press hasn't really caught on to, and what isn't chatted about in most Western investment circles, is that when you look at the lagging edge technology, you're seeing massive growth in China, where only 12 months ago, sort of less than a third of semiconductor manufacturing equipment would have been sourced within China itself. Today, that's close to 60% of the market. So a massive increase in market share. And a lot of that technology over time, as it continues to improve, will then be exported to the rest of the world. So while we don't expect that geopolitical uncertainty or the overhang to go away completely, what we certainly expect is that to be more demonstration of the strength of the Chinese kind of technology space with or without the ability to import technology on the leading edge semiconductor side. So with property overhang abating and geopolitical overhang abating a bit in 2024, that's why we think the catalyst of earnings coupled with valuation will be able to drive the market.
Right, so Brian, that makes sense. But one of the other risks for China, which obviously was one of the main reasons for its growth in the last cycle, but obviously a major hindrance for it now, is the property sector downturn. Now, Nick, I know you have some thoughts on this. We've debated this widely within the investment team. What's going on with the property sector in China, and why does this potentially pose a risk to Brian's thesis?
Yeah, I think it's an important one. And it's one, as you said, we discussed quite a lot internally. I think long term, I think the property market has been a big driver for China. I think the one thing about Chinese economy is that they're very long term. They really do think about what's going to happen in the next 10 years. So infrastructure, property development have all been very good and will enable good long-term growth for the future. But the thing we, I guess, discuss internally is, with it being almost 20% of the overall economy, how will that kind of deflate over time? Because that is a big number. And Brian, you did mention a little bit earlier about the significance of the property market. So I think it's worth discussing maybe that 20% of the residential property market and how it deflates without breaking the Chinese economy. Brian,
your thoughts on that?
It's a great question, Nick. And I mean, it is important to highlight that that property piece within China is 20-25% of GDP. And it is where the average Chinese consumer has the vast majority of their wealth. So deflating that portion of the economy over time and allowing other portions of the economy to take its place is a delicate balance. What we do see in the property market kind of slowdown, and I think this is important to highlight, is that the party has been managing the slowdown for quite a long period of time. So we saw President Xi a handful of years ago state quite unequivocally that houses should be living and not for speculation, right? We had already seen in the market that the down payment required for second homes, for example, was 40%. And for third homes, it was 100%. Chinese consumer wasn't allowed to use leverage to buy their third home. So the leverage, if any, within the system, not if any, there's certainly leverage there, but it doesn't sit on the consumer balance sheet side. And I think that is important to highlight. What the government has really managed to do and decided to do is that the pain will be taken either by investors or by banks, state-owned banks that are able to extend loans. So it's really not a solvency problem, but the government is committed to shoring up the industry enough to really restore consumer comfort and consumer confidence. So projects, for example, from developers that have run out of capital, we feel that the government is solving this in a sensible way. They aren't propping up the developer. I mean, developers that run out of capital should, over time, go out of business, and that is what we're seeing happen. But what is happening is that it's not the end consumer who's left holding the bag. There are funds being made available for property developers to finish the projects. And ultimately, that is what will restore sentiment. I mean, we see wage growth in China, even for the first half of this year, 6% in real terms. And so it's not a function of consumers not having capital to spend. It's just a function of shoring up consumer confidence within that property space, which holds so much of their wealth. And as that happens through 2024, that will be a significant catalyst for the market.